Today, when a grind down turns into a rout. Hello again, I'm Martin North from Digital Finance Analytics. Welcome to the Property Imperative Weekly to the 15th of December 2018, our digest of the latest finance and property news with a distinctively Australian flavour. Financial markets have remained weak through December, and it's prompting the question, is this more than just volatility? Are we seeing falls turning into something more significant? Is this the start of the rout? So, today we look at the latest data and try to assess where we stand. And by the way, if you value the content we produce, please do consider supporting our efforts. You can make a one-off donation via PayPal or consider joining our Patreon program. We really appreciate those who are contributing to help us to continue to make great content. The links are in the comments below. Today we start with the markets, which continue in a state of heightened volatility and uncertainty. The US Volatility Index went up again on Friday by 4.75% to 21.63, which continues the trend seen since October. A range of concerns from slowing global growth, trade tensions, and a potential yield curve inversion all played into the mix. This despite upbeat data from the Commerce Department at the end of the week, which showed that US consumer spending gathered momentum in November as households bought furniture, electronics, and a range of other goods, which could further allay fears of a significant slowdown in the American economy, even as the outlook overseas continues to darken. Plus, worries over the US economy's health were eased on Thursday after government data showed that the number of Americans seeking employment benefits fell back to a near 49-year low last week. And in a separate report on Friday, the Fed said that industrial production rebounded 0.6% last month after falling 0.2% in October. US retail sales, excluding automobiles, gasoline, building materials, and food services, surged 0.9% last month, after an upwardly revised 0.7% in October. These so-called core retail sales, which correspond most closely to the consumer spending component of gross domestic product, were previously reported as having gained 0.3% in October. And economists had forecast core retail sales rising 0.4% last month. November's increase in core retail sales and upward revisions to October's data suggested a brisk pace of consumer spending in the fourth quarter. Consumer spending, which accounts for more than 2/3 of the US economy, increased at 3.6% annualized rate in the July to September quarter. But this upbeat data from the Commerce Department bolsters expectations that the Federal Reserve will indeed raise rates for a fourth time this year in its December 18th-19th policy meeting, despite moderating inflation and tighter financial market conditions. The US Central Bank has hiked rates 3 times this year in the wake of the strong retail sales numbers. And economists bumped up estimates for the fourth quarter domestic product growth to as high as 3% from around 2.4% previously. The economy grew at a 3.5% pace in the July to September period. Spending is being bolstered by a tightening labour market, which is starting to spur faster wages growth, lower taxes, and moderate inflation, and it remains strong despite the sharp shock in market losses. It also stood in stark contrast to reports from China, showing a dramatic fall-off in retail sales in the world's second largest economy, and from Europe, where a key measure of business activity expanded at its slowest rate in 4 years. China said that it will temporarily reduce tariffs on imports of American-made cars, when the Chinese Finance Ministry said in a statement that it would cut tariffs on car imports from the United States to 15% from 40% for 3 months, starting January the 1st. The Chinese yuan, US dollar, was down 0.37%, to 0.1448. Yet, a sharp sell-off on Wall Street and partial inversion of the US Treasury yield curve has stoked fears of a recession. A poll released on Thursday showed economists now see the risk of recession in the next 2 years at 40%, up from 35% last month. And the Dow closed lower for the second straight week on Friday, as fears over slowing global growth triggered a steep sell-off across stocks on Wall Street. The Dow Jones Industrial Average fell 2.02% to end at 24,101 and is down 1.2% for the week. The S&P 500 dropped 1.91% to end at 2,600, while the Nasdaq Composite lost 2.26%, ending at 6,911. Apple weighed on tech as analysts continue to warn about weaker iPhone sales, sending its share price more than 3% lower to 165.48. Intel was down 0.89% to 47.86, and Google Alphabet was down 2.03% to 1,052. Amazon was down 4.01% to 1,591.91, and the S&P 100 was also down 2.09% to 1,153.59. Ahead of the Federal Reserve meeting next week, investors continue to abandon bank stocks, pressurizing financials, which have fallen about 10% so far this month. The S&P 500 financials was down 1.01% on Friday to end at 478, with Citigroup down and Goldman Sachs lower, down 1.79% to 172.77. The dollar hit a 19-month peak against a basket of currencies, up 0.42% to 97.47. And the US 10-year bond was down 0.61% to 2.893, while the 3-month rate was down 0.13%. Now, according to Fitch Ratings, the risk of an imminent US recession remains low, despite the recent flattening in the US yield curve. They say that the underlying recession signals traditionally embodied by a yield curve inversion, namely high policy interest rates relative to long-term expectations of policy rates and falling bank profitability and credit availability, are absent. Yield curve flattening does nevertheless emphasize that the US economic cycle is in a late stage of its expansion. The yield curve has been a good lead indicator of US recessions. Each of the past 9 recessions were predicted by a yield curve inversion, when 10-year yield fell below 1-year yields. The recent narrowing of the 10-year minus 1-year spread to its lowest level since the summer of 2007 has prompted a debate about potential economic implications. The yield curve has not yet inverted except at some shorter tenors. They forecast the US 10-year yield to end this year at 3.1% from 2.85% today, and predicts a year-end Fed funds rate of 2.5%. And they also see both the Fed funds rate and the 10-year yields rising broadly in tandem through 2019. So even if the yield curve inverts, there are reasons to discount this as a red flag, they say. The historical time lag between inversions and recessions have been highly variable, from 6 months to up to 2 years. The correlation between the yield curve and GDP growth has been far from perfect. While each recession has been preceded by an inversion, not every inversion has been followed by a recession. And the relationship through the mid-1990s was very poor. Since early 2010, there has been a steady flattening, whilst US growth has remained broadly stable, they say. Solid consumer income, private investment momentum, and an aggressively expansionary fiscal stance should all support strong US GDP growth in the next 12 months, they say. Nevertheless, the flattening yield curve is consistent with the US economy being at a late stage in the cycle, with an unusually long expansion to date and growth currently well above Fitch's estimate of US supply-side growth potential of 1.9%. So Fitch expects US growth to tail off quite sharply in 2020 to 2% from 2.9% in 2018 as macro policy support is removed and supply-side constraints start to bind. Finally, oil was down 2.68%, sitting at 51.17. Gold futures fell 0.43% to 1,242.05, and Bitcoin continues to languish, down a further 3.47% on Friday to 3,231.40. Brexit uncertainty raged on after Prime Minister May survived a vote of no confidence in the week, but then made little progress in negotiations in Brussels, suggesting that the final decision will come down to the wire. The FTSE 100 was down 0.47% to 6,847.17. And the uncertainty continued to drive UK financial lowers, with the FT Finance Index down 0.51% to 617.71. The British pound US dollar was down 0.39% to 1.2587, and the euro US dollar was down 0.49% to 1.1305. Deutsche Bank, the bellwether German bank, was up 0.11% to 7.744, still in red alert territory. Locally, the market had another bad week, with the local fear index up 3.37% on Friday to 16,908, mirroring the US VIX. The ASX 100 fell 1.05% to end at 4,612.40. Banks had another bad week, and not helped by the Reserve Bank of New Zealand's Friday release of its plans to lift capital requirements higher ahead. The ASX Financials Index was down 1.63% on Friday to end at 5,493.29. Westpac was down 2.20% to 24.88. ANZ was down 2.71% to 24.80. NAB was down 1.7% to 23.69, and CBA was also down. Bendigo Bank was down 0.48% to 10.33. The Bank of Queensland was down 0.31% to 9.56, while Suncorp rose 0.08% to 13.02. Macquarie Group was down 0.72% to 113.18. And Genworth, the lender's mortgage insurer, was down 3.75% to 2.31, while AMP rose 1.75% from its lows to end at 2.33. Aggregator Mortgage Choice put out a profit downgrade warning, saying mortgage settlements would be 10% lower than last year, and ended at 111. The Aussie ended at 71.72 against the US dollar, down 0.75% on the day, and continues its weak trend, having fought a little higher in the week. The Aussie Gold Cross was up 0.41% to 1,725.87, and the Bitcoin Aussie Cross was 9.89% lower on Friday to 4,180. So really no good news from the markets, and no reason to think falls will reverse. And it's worth noting that bank funding costs, as represented by the bank bill swap rate, are on the move and higher again, so bank margins will be under yet more pressure. Household financial confidence slid again, using our household survey to the end of November 2018. The overall index fell again down to 87.8, well below the neutral setting and close to the record low that was measured in 2015. Property-owning household segments continue to react to the changed environment as prices weaken and mortgage availability tightens. Around half of all mortgage applications are being rejected due to the tighter conditions. Property investors are now very concerned about their financial status, and owner-occupied households' confidence continues to drift lower. That said, those not owning property, those who are renting or living with family or friends, are still even less confident. So it is still true that property ownership bolsters financial confidence. We discuss the details in our post-household financial confidence on the blink again. The most astonishing news this week came from the Council of Financial Regulators. In their first ever release of minutes from their quarterly meeting, they belled the cat, arguing that the banks are now being too strict in their lending standards and should lend more. In effect, this means that the shadowy power, when the Treasury, the ACCC, ASIC, APRA, ATO and the RBA, chaired by the RBA by the way, is endorsing the predatory mortgage lending which has become a feature of the Australian market, and implicitly condoning the poor practices exposed by the Royal Commission and the ACCC. Let's be really clear, debt is too high. People have been lent too much, which is why the debt ratio is so high, and this has created the biggest risk to our economic future. Now the banks are running scared, having been reminded what the law says about responsible lending, and have adopted more rational lending policies. Better late than never. Yet, even now, mortgage credit is still growing at around 5%, and clearly the RBA wants more. This is being funded by yet more offshore funding, and over the year to September 2018, Australian banks' offshore borrowings rose by $62 billion, up 6.8%, with bonds up $44 billion and loans up $14 billion. In fact, this lending has been behind the property price rises that we've seen. But this creates its own risks. And all of this is so far from what the RBA is there for, to control inflation, drive employment, and safeguard our prospects. It's just not funny. And they also said that if needed, they would cut the cash rate and print money in answer to a specific question following a speech. Frankly, I think we need a royal commission into the RBA. It has truly lost the plot. And we should also add in ASIC and APRA too. Personally, the only team in town who are looking after our interests is the ACCC. Their report on mortgage pricing, which is discussed in our post The Great Mortgage Rip-Off, makes the point that loyalty is not rewarded, mortgage discounts are deliberately obtuse, and while it is possible to save loads by shopping around, the process is hard to do. And the APRA data for the quarter, which we discussed in our post Home Price Falls Accelerate and Will Bank Capital Be Impacted, shows that investment lending and interest-only lending is down, but that more loans are being written outside normal underwriting criteria. We also argue that as home prices slide, there are implications for bank capital, and of course underwriting standards need to adjust to potential falls, with higher loan-to-value loans becoming less available. And the RBA also this week endorsed Australian equities, making the point that when interest rates go down, share prices tend to increase, and this increases the wealth of households who hold those equities. In addition, over the long run, they said, equities have been worth more to investors than other investment options. They have returned about 5 percentage points more than long-term bonds on average each year. Yet the equity market is more volatile than many other markets, so contains more risks. The ASX is bank heavy, and the financial sector more broadly makes up about a third of the exchange by market capitalisation. And finally, on a price to earnings ratio basis, Australian equities are not showing signs, they say, of heightened valuations. Perhaps they should have added that until recently about half of all dividends came from the finance sector, though that may change in the next few years given the slowing lending market and the focus on wealth management efficiency and fairness. And they should have also shown the distribution of large international investors versus smaller local mum and dad investors. And remember, the reason stocks are so high is because of loose lending and ultra low interest rates, both of which may change ahead. The Reserve Bank in New Zealand has also encouraged more household debt to stoke the economy, as I discussed with our New Zealand property expert Joe Wilkes this week in Flipping and Flopping in New Zealand. But they also shook the market this week with a discussion paper in which they consult on proposals to lift the capital held by banks in New Zealand. The expected effect on banks' capital is an increase of between 20 and 60%, and this represents about 70% of the banking sector's expected profits over the 5-year transition period. But they say only a minor impact on borrowing rates is to be expected. And you can read the details in our post, RMBZ to lift bank capital requirements. CoreLogic data released this week also shows a fall in home prices. Values in Sydney are on average now down 10% from their peak, 15% in Perth and 6% in Melbourne, and expect more falls ahead. But as we say, the market is quite different. As their data at the SA3 level shows, some have done very well this year, with annual rises of more than 16% in some areas of, for example, Tasmania, around 8% in the Woorden Valley in the ACT, and 4.9% in Queensland's Central Highlands. But the same is true in the falling markets, with areas in Queensland down more than 15% this year, and some areas in New South Wales not far behind, for example, Pennant Hills. And many areas of New South Wales are down more than 10%, including Liverpool, Parramatta and Hunters Hill, as well as in Victoria, for example, Bayside and Manningham. And we see the falls continuing in many areas of WA and Queensland. 28 of the top falls, though, were in New South Wales. And they also reported that there were 2,631 homes taken to auction across the combined capital cities last week, and that returned a final auction clearance rate of 41%. The weighted average has continued to decline over the last 4 weeks, surpassing the previous week as the lowest recorded since October 2011. Last year, a significantly higher 3,371 capital city homes went to auction, and that returned a clearance rate of 59.5%. Melbourne's final auction clearance rate came in at 43.8% last week, and there were 1,283 auctions held across the city, down from the week prior when 1,378 Melbourne homes were taken to auction, and a lower 42.7% cleared. In Sydney, a final auction clearance rate of 41.3% was recorded across 870 auctions, down from the previous week's 41.6%, when 937 auctions were held. And across the remaining auction markets, Canberra returned the highest final clearance rate of 43.7%, while only 22.4% of Brisbane homes sold at auction last week. Of the non-capital city auction markets, Geelong returned the highest final clearance rate of 47.3% across 61 auctions. And the combined capital cities are expected to see a lower volume of auctions this week, with CoreLogic currently tracking 2,285 auctions, down from last week. And we can also see that vendor discounting is growing, around 8% in Sydney, 6% in Brisbane and 8% in Perth. Darwin holds the record, though, at more than 9%. And time on market continues to rise, with Darwin units on the market for more than 100 days, while Sydney and Melbourne are close to 40 days now, and in some cases we know properties are withdrawn when they do not sell. And the CoreLogic transaction volumes are also down. Over the 12 months to November 2018, turnover of national housing stock was recorded at 4.6%. Over the 9 years shown on the chart, it was the lowest turnover of stock and was down from 5.3% the previous year. Turnover has been trending lower since it was recorded at 6.3% in mid-2015. All this points to more falls in values ahead. Now, Shane Oliver from AMP said this week, "For years, we have felt that the combination of surging household debt and surging house prices was Australia's Achilles heel, in that it posted the greatest domestic threat to Australian growth should it all unravel. But we also felt that in the absence of a trigger, it was hard to see it causing a major problem. However, over the last year, a combination of factors have come together and create a perfect storm for house prices in Sydney and Melbourne. These include poor affordability, tight credit conditions, a surge in the supply of units, a collapse in foreign demand, borrowers switching from interest only to principal and interest loans, fears by investors now that changes in negative gearing and capital gains tax, if there is a change in government, assuming Labor can get it through the Senate, will reduce future demand for their property investment. All of this is seeing the positive feedback loop of recent years of rising prices leading to rising demand, leading to rising prices, etc., giving way to a negative feedback loop of falling prices leading to falling demand, leading to falling prices, etc. This could all be made worse if immigration levels are cut sharply. Auction clearance rates have fallen to record lows, which for Sydney and Melbourne are consistent with further price falls running at 8 to 10% per annum, and housing credit continues to slow. He concludes, house prices in Sydney and Melbourne will likely have a top to bottom fall of around 20% and 10% in 2019, and national average prices will likely have a top to bottom fall of around 10%. This will have an impact on growth of around 0.4% directly, plus more indirectly. He calls out a reduced demand for household equipment, retail sales, as dwelling completions top out and decline, a negative wealth effect on consumer spending of around 1% per annum, Rising housing wealth helped drive decent growth in consumer spending in New South Wales and Victoria as households reduced the amounts they saved as their housing wealth rose. This is now likely to go into reverse, detracting around 0.6 percentage points from GDP growth. And there could also be a feedback loop into further bank credit tightening if non-performing loans and defaults rise. So he says, taken together, these could detract 1 to 1.2 percentage points from a growth over the next year. Barring a deeper property slump, he says a recession is unlikely. Well, I hope he's right. So we think there is more downside risk both locally and internationally, and we suspect there will be more falls ahead. However, it is too soon to pick whether things will just grind lower or whether a rout is coming. We need to keep watching the data for more severe and consistent falls, which would signal the latter. This could move quickly if the skids really start rolling. Before we sign off, a quick reminder. Our final live stream event will be next Tuesday, the 18th of December at 8 p.m. Sydney time. During the session, we will review the year and also discuss the outlook for 2019. The event is already scheduled on YouTube. Here is the link so that you can add a reminder. And do come and join the live chat, where you can ask questions in real time or send me a question beforehand. I look forward to seeing you. And by the way, if you value the content we produce, please do consider supporting our efforts. You can make a one-off donation via PayPal. That's a new facility. Or consider joining our Patreon program. We really appreciate those who are contributing to help us continue to make great content. The links are in the comments below. And as always, if you like what you've seen here today, please share and like the post and add a comment or question. I read them all. And if you want to join the growing band of subscribers who receive alerts when we release new posts, do subscribe now by hitting the subscribe bell. And if you have already subscribed, many thanks. I really appreciate your support and participation. I'm Martin North, the Principal Analyst at Digital Finance Analytics. Many thanks for watching, and I'll see you next time.